What role do MMFs play in the shadow banking system? Imagine a world where money flows smoothly outside traditional banks, helping businesses and investors meet their short-term needs. That's where money market mutual funds, or MMFs, come into play. They are a big part of the shadow banking system, which operates alongside regular banks but isn't regulated the same way. MMFs gather money from investors who want safety and quick access to cash. They then invest this money mainly in short-term, low-risk securities like commercial paper and asset-backed commercial paper. These are short-term loans issued by banks and companies to cover immediate expenses. By buying these short-term debt instruments, MMFs help channel credit from investors to businesses and financial firms. This activity supports the flow of money in markets, making sure companies can pay their bills and keep operations running smoothly. MMFs act like a bridge, connecting investors looking for safe, liquid assets with companies needing quick funding. They provide an alternative to traditional bank deposits and loans, especially for those who want to keep their money accessible but still earn some return. The shadow banking system is made up of entities that do many things banks do, like lending money and managing maturity mismatches, but without the same rules. MMFs fit into this system because they borrow money from investors for short periods and invest in slightly longer-term assets. This creates a mismatch, similar to what banks do, but without access to government safety nets like deposit insurance. Since the 1980s, MMFs have grown a lot. Investors like them because they offered safety, liquidity, and better returns than regular savings accounts. By the 2010s, they held trillions of dollars in assets, making them a major part of short-term funding markets. But this role isn't without risks. Because MMFs invest in assets that aren't fully insured and can be subject to sudden withdrawals, they can cause problems during market stress. During the financial crisis of 2007 and 2008, a run on MMFs threatened broader financial stability, leading the Federal Reserve and the Treasury to step in with emergency measures. After that crisis, rules were changed to make MMFs more resilient. These reforms included stricter liquidity requirements and new ways to calculate their net asset value, which is how they report their value daily. Despite these changes, MMFs remain a vital part of the shadow banking system. They continue to provide essential short-term funding and liquidity to financial markets, helping keep the wheels turning smoothly. In summary, MMFs act as a link between investors seeking safety and liquidity and businesses needing quick funding. They operate within the shadow banking system by offering an alternative source of credit outside traditional banks. Their growth and evolution reflected how shadow banking has developed as a parallel financial system that both supports and challenges the stability of traditional banking.